Hello, my name is Sarah Hendy and I'm the Strategic Partnerships Manager here at Blackfinch Investments. Thank you for joining me today for this Blackfinch Masterclass, where I'll be looking at some of the key differences between EIS and VCTs before turning my attention to some tax year end considerations. But before we start, obviously the important information. Blackfinch Investments is authorised and regulated by the Financial Conduct Authority, and whilst all reasonable care has been taken to ensure that the contents of this masterclass are true and accurate, no representation or warranty, express or implied, is given as to the accuracy or completeness of the information or opinions contained in this recording, and no liability is accepted by Blackfinch Investments. Now, I appreciate that some of you will already have more knowledge on this subject than others, but it is important to cover off some of the key points. So for those of you who are more familiar with these products, hopefully this will act as a refresher and a bit of a timely reminder for any end of tax year planning that you may be undertaking. So I'm going to start with a brief history and cover off some of the key legislation and obviously the tax reliefs before moving on to those tax year end considerations. Now, EISs were launched back in 1994 and VCTs a year later in 1995. Now, since that time, there have been many changes, including an increase in the amount of income tax relief from 20% to 30% in 2011, and for VCTs, an expansion in the 2011 tax year to allow greater levels of investment into larger companies. Both schemes were subject to the changes in EU state aid rules in 2015, which subsequently saw all electricity generation excluded as a qualifying trade in the UK. Now, the most recent changes were the introduction of the principle-based approach in 2018, which some of you will remember is when we first started talking about knowledge-intensive companies, and I'll come on to that in a moment. Now, we are really lucky in the UK as we have 4 tax advantage schemes. So you have your seed EIS, your EIS, the social investment tax reliefs, the SITRs, and then the VCTs themselves. And the purpose of all of these is to encourage investment into small and medium-sized companies in the UK. And obviously with COVID and Brexit dominating our lives at the moment, never more has investment into these early stage companies been so important. Now, as I said, they are intended to support early stage entrepreneurial companies that might have the potential to grow in the long term and that might otherwise struggle to obtain investment from other sources. Now, I'm not going to dwell on all of the specific rules, but it is important to point out some of the key points. As I mentioned, the last major legislation changes saw the principle-based conditions come into effect in March 2018. And these included the risk to capital condition, new rules governing size and type of company, which is where that knowledge intensive comes in, updates on qualifying and excluded trades, and amended rules governing the raising and spending of funds. As I said, I'm not going to dwell on this subject, but I will cover this off in more detail in the supporting notes for those of you who aren't so familiar with this subject. So the main points for you to be aware of in relation to the risk to capital conditions are 1, whether the company has objectives to grow and develop over the long term, and 2, whether there is a significant risk that there could be the loss of capital to the investor of an amount greater than the net return. Now, the second point is obviously a factor that needs to be taken into account when assessing whether your clients are suitable for these types of investment, and I will come on to suitability in a moment. Changes to the rules governing the raising and spending of funds now state that a company can receive 5 million in any 12-month period, or 10 million for those companies that qualify for knowledge intensive. Now, over a firm's lifetime, it can receive multiple investments as long as they don't exceed £12 million, or for knowledge intensive companies, it's £20 million. As long as it obviously still conforms to the other rules governing things such as the size of the company. Now, as I just mentioned, companies are not restricted in only receiving one tranche of investment from EIS or VCTs. And many companies will actually receive a small initial amount and then, depending on their performance, receive a follow-on investment if the company is performing well or above expectations. And actually for providers, they will usually insist on having a non-exec sitting on the board as part of the criteria for receiving investment. And the beauty of this is that they will be monitoring the company's progress, as they may also have an open VCT with funds to deploy, and watching to see whether making a subsequent investment via their VCT at a slightly later stage in the company's life cycle would be a good investment. And again, the investment life cycle is something I shall cover off shortly. Now, as I've referred to knowledge-intensive companies several times now, I want to just let you know what the definition of knowledge-intensive is according to the FCA. So, in order to meet this criteria, a company must, in at least one of 3 years prior to investment, have spent 15% of operating costs on research and development or innovation, or in each of those 3 years have spent at least 10% of operating costs on research and development or innovation. Now, in addition, the company must also meet either the innovation condition, which is based around the creating and then the subsequent exploitation of the product, or meet the skilled employee condition, which means that at least 20% of the workforce has a higher education certificate or qualification and is engaged directly in research and development or innovation activities. And this is actually a key point, as from the government's point of view, it opens up job opportunities for those young people who are exiting higher education or university. Now, there are several different types of VCTs, and broadly speaking, these can be broken down into 4 main categories. So you've got generalist, aim, specialist, and lifespan. Now, generalists are the most common and most popular with investors, and they invest in a broad range of companies in different sectors at different stages of development. VCTs are all classed as investment companies and have closed-ended structures. And most importantly, the majority of VCTs will offer buyback schemes for exiting clients. However, do note that these can be discounted depending on how long the VCT has been running. And again, this is something you just should be aware of and ask the provider before investing so that you can just manage your clients' expectations. Now, with EISs, there are generally 3 different categories: single company, alternative investment funds, and EIS funds. Now, a single company gives an investor greater visibility and control, but obviously it also carries greater risks and less diversification. Also, do just note that most PIs don't cover for advising on single company EISs or can be very expensive, so it is well worth checking. Now, the most commonly used are EIS funds, but just a note for those of you who may be newer to the world of EISs, they're not actually funds. They are investment portfolios that pool investors' monies in line with the fund's specific mandate. Now, EIS funds offer increased diversification, and most provide ongoing oversight of investee companies, as well as I've just mentioned, usually having a seat on the investee company's board, which can be really crucial to their success and also help providers consider them for either follow-on or VCT investments. Okay, so I now want to move on to some of the main risks. And from an advisor's point of view, the main risk is obviously client suitability. But actually before that, should any of you or maybe your team require a bit more of an in-depth refresher or some additional support, then please do get in touch, as we can arrange for the relevant business development manager to come and provide a bit of training for you. Or obviously at the moment, because we're back in lockdown, via Zoom or Teams, whichever is the most convenient. Now, most providers will also have some form of independent report, but just a word of caution here. It's really important to understand how to interpret independent reports and to not just rely on those that provide a score. And again, this is something that we can help you with if required. So moving on to client suitability. We all know just how important this is, and it's even more important now in light of the FCA's missive on their alternative supervision strategy. As a reminder, this letter was issued last January, and it's actually really helpful as it does outline the FCA's view on the key risks of harm that alternatives pose and what they consider the supervisory priorities to be. So I'd really recommend reading this if you've not done so already. So when you are considering alternative investments for your clients, some of the main points on suitability to cover off are understanding and/or experience. Clients must have the ability to understand the nature of a VCT or EIS, and ideally should either have experience of investing or will have experience in business or a profession and therefore have the ability to make informed decisions about the investment. Your client's capacity for loss should enable the investment to fail and it not to have a detrimental effect on their everyday financial matters. They should have a high tolerance and attitude to risk. Now, attitude to risk and capacity for loss are often coupled together, as, for example, if you take two completely different people, maybe a solicitor and a mechanic, on a risk profile scale, they may have the same attitude to risk, but due to their financial positions and potential earnings, could have a completely different capacity for loss. A very important point to understand is the investment timescales, and suitable clients should expect their capital to be tied up for 5+ years. Just because the minimum hold period for an EIS is only 3 years, this will not necessarily mirror the targeted exit strategy for the fund manager, and as such, from a liquidity point of view, should a client think they could need to access their money within the minimum hold period, then the investment is not suitable for them. As we all know, the tax benefits alone should never be the main factor for the investment, as these can be withdrawn. However, clients typically would be in a position to take advantage of the tax reliefs, so long as the other considerations have been met. Most importantly, a suitable client for a VCT or EIS should already have a balanced portfolio of conventional investments so that the risk of investing in either a VCT or EIS can be more than offset elsewhere. And finally, a point that you may now want to include in your client fact find and suitability reports is that of ESG, and whether this and responsible investing is important to your client. Now, hopefully you are already aware that we at Blackfinch do already have ESG factored into all of our investments, both on the mainstream and on the tax efficient side. And actually more providers today are now offering EISs and VCTs that have either an ethical or a sustainable focus should you have clients for whom this is important. Actually, just very briefly on that point, as you may not be aware, but the FCA announced in December that they wouldn't now be implementing the SFDRs, the Sustainable Finance Disclosure Regulations, in March this year, along with the rest of Europe. Now, this was due to the fact that, rightly so as it turns out, they didn't believe that UK Parliament would legislate these regulations by the December 31st deadline. However, within the ESG and responsible investment world, it is still believed that the government will introduce some form of new legislation, particularly following the government's very public Greening Britain campaign. But what that will be and when it will be, we'll just have to wait and see. But if this is of interest and you would like to find out more, then again, please do get in touch with us afterwards. Okay, looking now at the main risks associated with EIS and VCTs, well, these can be broken down into 5 main categories: liquidity, product, market volatility if listed on AIM, tax risk, and exit risk. So picking up on the exit risk, the main difference between the two schemes is that EISs don't offer buyback schemes and there is no active secondary market. So for clients looking at EISs, understanding the timescales involved and the fact that their money is tied up for the duration is crucial. Clients also need to understand that their capital may also not be returned in a lump sum. Now, if you consider EISs, most clients will have a portfolio of maybe 6 to 10 companies, and the exits may be reliant on a trade sale or an MBO, so will probably all exit at different times. Now, both schemes may be reliant on a smaller number of customers and could have less capital to withstand a decline or a downturn in sales. And actually, those of you who already have clients invested, particularly in VCTs, this is something that you may need to focus on now with the impact that COVID could have had of some of the more established VCTs and the potential reduction in any dividend payments. So it's probably worth a conversation with the providers just to understand their position so you can keep your clients updated. Now, newer companies may take longer to realise profits or generate income streams. Companies must always adhere to the qualifying conditions and not just at the investment stage, or tax reliefs could be withdrawn. And actually, this is really important, and you should always question whichever provider you're working with about their monitoring process. Now, it's something that we at Blackfinch take very seriously, and as such, we work with a company called Philip Hare and Associates, and they're considered to provide the gold standard when it comes to their approach and their advice. And obviously, returns are targeted, not generated. Okay, as I mentioned earlier, I want to now talk a bit about the investment stages to help explain when typically EIS or VCT investments are received by a company. Now, most companies will start out with what we at Blackfinch call a minimum viable product. Now, it's usually when family and friends or maybe angel investors are approached for financial aid. And it's the highest risk stage, and founders are probably still generally working on testing and creating their products. And it's quite common for these companies to fail at this stage. But for those that then progress, they get to what we call the product market fit. They're usually on the cusp of their scale-up journey, and this is typically when EIS investment comes in. The company is still in its early stages and maybe still pre-revenue, but traction is gathering. Now, the final stage is growth, so the company should now have a strong understanding of their customer base, have product in the market, and have started to generate income. And this is typically when you tend to see VCT investments being made. There is still some risk at this point because companies can get there after a relatively short period of time. So again, monitoring in these early stages is crucial. The other important thing to understand is what the actual investment criteria is and how a provider manages and balances risk. So for example, at Blackfinch, we look at companies at all stages, and we may make investments in pre-revenue companies if they are showing really good metrics. But we then balance these with later stage investments in companies that are in their post-profit stage and already generating significant income streams. Okay, so moving on now to the reliefs. Well, it's 3 and 5. So a VCT has just 3 potential reliefs: up to 30% income tax relief with a minimum hold period of 5 years, tax-free dividends, and tax-free capital growth. The permitted maximum investment for an individual is £200,000 per annum. Now, an EIS also offers up to 30% income tax relief, but only requires a 3-year minimum hold. It also has the added bonus of the ability to utilise carryback, so an investor can maximise the potential income tax relief. EISs also offer CGT deferral, and as investments are made in limited trading companies, IHT relief via qualification of business relief once the shares have been held for 2 years. Now, most importantly for an EIS, though, is loss relief and the ability to claim this on any of the investment companies that fail. The permitted maximum investment for income tax relief in EIS is increased to £1 million per annum, or £2 million if investing in knowledge-intensive companies. Now, there are also some additional income tax relief conditions for VCTs and EISs. Obviously, an investor's overall income tax liability cannot be negative. You just can't claim back more than you've paid. Unlike an EIS, which offers investors the chance to offset income tax paid in the previous year, for a VCT, the relief is only available in the year the shares were issued. Income tax relief from both schemes is only available on new shares, which is important to note if you have clients that might be buying VCT shares on the secondary market. But now a bit of the bad news. HMRC will look to claw back income tax relief if the shares are sold or the VCT or EIS loses its approval status within that minimum 3 or 5 year hold period, even if those shares are sold at a loss. For EISs, another income tax point to note is the ability to offset losses against either a capital gain or income tax. However, do note that investors can't claim income tax relief if they are either connected or employed by the company receiving the investment. The only exception here is those business angels who are effectively unpaid directors. And finally, income tax relief must be claimed in order for the growth to be tax-free on an EIS. Now, there are also some points I want to mention about VCT dividends. So for those clients who complete a self-assessment tax return, dividends don't need to be detailed. Unlike income tax relief, there is no minimum hold period to qualify for tax-free dividends, but obviously they can only be claimed on the permitted maximum investment of £200,000 worth of shares in any 1 year. Another plus point for VCTs is that they also offer a dividend reinvestment scheme. And as long as the shares bought from the dividend reinvestment are classed as newly issued shares, these can also qualify for income tax relief. However, if an investor sells their shares in a VCT, it is not possible to claim tax relief on new shares bought in the same VCT within 6 months of the initial sale. Finally, one of the key attractions of EISs, as I mentioned earlier, is the ability to defer CGT, and this is known as reinvestment relief. Now, a capital gain, whole or portion of, can be offset by investing into shares in an EIS qualifying company, and the gain is deferred until the investor sells the shares. This gain can have arisen either 3 years before or 1 year after the investment was made. So for those of you with accountancy connections, this is a really good one to talk to them about, because if they have any clients that may have paid a gain within the previous 3 years that they weren't particularly happy about, it could be an opening for you to have a conversation with them about maybe using an EIS to get back that CGT that they've already paid and then defer it. However, do note that the investor must be a UK resident, and the deferral can only be achieved once the EIS 3 certificate has been received. And actually on that point, again, this is really important to understand what the provider's expectations are regarding timescales of those ES3 certificates. As I mentioned earlier, your clients will typically be invested in 5 or more companies, and each trading company will issue their own EIS3 certificate. So your clients may end up receiving multiple certificates all at different times. So again, when undertaking your client suitability and just to manage your client's expectations, this is something that you do just need to bear in mind. Okay, that now brings me to the final part of this masterclass, where I wanted to highlight some tax year-end considerations for you. And I'm going to start by highlighting some of the potential clients for EIS and VCTs, and then match scenarios as to why they could be of interest. Now, as this is for illustration purposes, I'm just going to assume that on a suitability point of view, that it's already been established that the clients are all suitable. So one of the typical client groups that we regularly see is company directors. They are usually very well remunerated, so one of the potential reasons for them considering EIS or VCTs is obviously to help them reduce the amount of income tax they pay. Now, another frequent reason for company directors is to use the income tax relief they have received from an EIS or VCT to then help offset any dividend tax that they may have incurred if taking a larger dividend. Now, for landlords or those with buy-to-let portfolios, an EIS could be of interest to again help reduce income tax, but primarily to defer a CGT liability should they have sold one of their properties. And actually, you'd be quite surprised at the number of older people who do consider EISs when they're selling a second home that they no longer require. Often the main driver for them is just to actually free themselves of the upkeep and the burden of the second property as they're getting older. And actually they may just want to release the capital to gift it to the grandkids or their own children. Now you might think, well, you know what? What's the point in deferring a CGT liability when you've still got to pay it when the EIS matures? Now, if that sounds like a sentence that you were going to utter, then do get in touch with us afterwards and we can actually show you that with some careful EIS planning, they can actually be used to clear the liability completely. Okay, other potential clients include those people who may only be able to make limited pension contribution, or clients that have already exceeded their pension lifetime allowance. Now, both products can help these clients to reduce income tax or just to grow their wealth. A pension pot of just over £1 million may not be enough for those clients who have always enjoyed a high salary and the trappings and lifestyles that they could afford when they had regular income coming in. Now, the last client group that I wanted to highlight is those that are just seeking extra diversification and have an appetite for higher risk investments. Most EIS or VCTs actually have a relatively small minimum investment level. And don't forget, the benefit of having VCTs is that hopefully they will be paying out regular dividends, which, as clients get older and maybe retire, can provide a great addition to their pension pot. Now, another point I want to mention is the important part that diversification can play in helping with risk management. Now, typically, EIS and VCTs are classed as an 8 out of 10 on the risk scale, but you can help manage the risk through a well-diversified asset allocation. Now, this is particularly helpful for those of your clients that are either regular EIS or VCT investors, or those that you know could have a long-term appetite of higher risk investments, and you can put together an annual allocation strategy and maybe budget for, say, 4 to 5 years, and then each year ensure that the investment is made within either a different asset class, or if you are considering, for example, more than one tech company, a different subsector or type of product. Now, staying with that theme, it's also important to find out when you're doing your research about which products are available each year, what the asset allocation will be. And by that I mean how many companies will a provider be looking to invest into, and most importantly, how many will be invested in the current tax year. Now, obviously, this is really important client consideration when determining exactly when your client needs their tax relief. So, for example, are they looking to utilise carryback, in which case the monies must be invested in the current tax year, as you can only carry back to the previous tax year. Now, the last point I wanted to mention, and it's something I touched on earlier in the session, is actually the importance of not taking things at face value and understanding exactly the impact that certain things could ultimately have on your client's investment. And this really is the case when you think about fees and their associated costs. As you might expect, there are a wide range of fees that are applied to both EIS and VCTs. Now, obviously, you have your own fees to consider, and then there are those that are that the product provider applies, as well as the costs incurred by the actual underlying trading companies themselves. Now, things to consider include understanding how and when the initial fee is applied, so whether this will reduce the net investment, which will impact the amount of tax relief that can be claimed, whether there is a dealing fee, what the ongoing fees are. And the one that we find does tend to get overlooked is the performance fee, and most importantly, the hurdle rate at which this is applied. This is something that I would highly recommend you do spend some time on, and maybe put together a spreadsheet to determine what the potential impact of a performance fee could be over the life of the investment, as it could make a huge difference to the return your clients will potentially receive back themselves. Okay, so that brings me to the end of this part of today's session. So obviously, do let me know if you have any questions. And thank you so much for listening. I hope you found that of interest. Thank you.